Hello everyone, welcome you all to the Achievers Adda. So from today onwards, we are starting with another series that is Commerce Top MCQs. So on topic wise basis, I will be discussing daily one topic will be taking up and discussing the previous year questions are the most important MCQs for the commerce, and this is going to be useful for the UGC NET Commerce and Management as well as AP, JL and DL examination commerce paper and Tamil Nadu assistant professor, Andhra Pradesh, Telangana set commerce also. So wherever commerce paper is there, these subjects are common to all and the questions also maximum more or less nearby the same level. So this series will be useful to you all and you can join in our Telegram group. Before that, if you are first time over here, please do subscribe to this channel and stay tuned to this channel. So alternative day live will be there or else maximum daily also live will be there. It will be informed over in the group only. Right? So please do subscribe and hit a like button and share with your friends. Today we will be discussing first session number 1 or a part number 1. Financial management MCQs will be discussed. Financial management MCQs will be discussed today. With explanation it is going to be there and you have to participate in the chat box. You have to give the answer for every question, then it will be useful and it will be interactive also. You can join in our any one group from the link given below. If you are preparing for UGC NET and SET exam, Telegram group is available. The link is below in the description. And if you are preparing for Commerce Assistant Professor, you can join into Tamil Nadu TRB's Commerce Assistant Professor separate group is there. APR Telangana set WhatsApp groups are available and AP JLDL Commerce group is also there separately. Join in any one group only so that you will get the update regarding it. And if you are preparing for UGC NET or Assistant Professor examination, complete course for the paper 1 and paper 2 Commerce is available. So for the both papers 6199, if you want only a single paper 3599, you can able to get it. For the complete preparation of your T and TRB also, you can go for the paper 2 Commerce at just a 3600. Everything will be there, complete course. And if it is APPSC, TTD, JLDL Commerce paper, then 4500 full recorded course, complete coverage of entire units in a Telugu plus English explanation. And AP Telangana paper 1 Telugu plus English explanation, only paper 1 1999, both papers paper 2 Commerce and English medium 3499. This is fully a recorded course, you can get it. So now let's get into the session. If you want only a paper 1 for AP and Telangana, you can join for the single paper also. 1999 will be the price. All the course prices are very less at our platform, so which is useful to you, and you can hit a like button. Do comment your answer in the chat box. I'm starting with a financial management MCQs today. Question number 1 is here. Question number 1 is here. Very carefully read the question. Question looks like very small, but I wanted to take from small questions to will increase the level of questions. Slowly will increase the level of questions. Very good evening after a long time. Which of the following is not a method of preparation of the cash budget? Financial management questions we are discussing. Very good morning. Good evening. Very good morning. Answer please in the chat box quickly. Which is not a method of preparation of cash budget? Pro forma balance sheet method, adjusted net income method, cash cycle method, receipt and payment method. So what will be the correct answer? Answer please. For preparing a cash budget, we have various methods. So which is not a method they are asking? Which is not a method? Answer is that option number. Answer is option number C. There is no method called as a cash cycle method. Cash cycle method is not there. For preparation of the cash budget, generally in the working capital management, cash management, inventory management, receivables management, creditors management we have. So in that cash management, we have two models, Baumol model and Miller ORR model. Two models are there. One is stochastic model, one is other model. But here in the Baumol model and Miller ORR model, these are the models to maintain the optimal cash balance. But here for preparing the cash budget, there are three methods which we can able to take into consideration. One is receipt and payment. This receipt and payment will be taking if the cash received and cash paid, only that will be recorded. Adjusted P&L method, which is adjusted profit and loss account method, and balance sheet methods are the three methods are available for preparing the cash budget. But there is no method called as a cash cycle method, which is there in the option number C. Right, next question related to leverage here. Sale of a firm is 40 lakhs. Variable cost is 10 lakh. Fixed cost is 15 lakhs. Interest is 5 lakhs. Now combined leverage they are asking. Actually leverage, combined leverage formula is what? Operating leverage into financial leverage. Right? Operating leverage into financial leverage. Now we should identify how to calculate the combined leverage without taking operating financial leverage into account. Direct combined leverage formula we can apply. How much will be the answer? What will be the combined leverage of the firm? Simply. Answer first. Hello Rajesh. Afsar ji, namaste. ఎలా ఉన్నారు మీరు? నేను బాగున్నాను. హలో హీనా, జ్యోతి లక్ష్మి, నథీరా, హరి, గోపాల్, సంతోష్, విజయలక్ష్మి, గీతా, బబితా, జ్యోతి. Yes, Jiva, you are correct. Oil into FL. But is there any need to calculate the operating and financial leverage? We have a combined leverage direct formula, na? We can apply it. So here, simply for getting sales minus variable cost, sales 40 lakhs minus variable cost 10, then 30 lakhs will be an contribution minus fixed cost 15 lakhs, then remaining 15 lakhs will be EBIT or operating profit we call it as. From this interest also available. If you remove the interest 5 lakh, then 10 lakh will be the earnings after interest or earnings before tax or after interest, we can say. So final answer will be 3, option 3. How it is 3? Combined leverage directly we can apply. We arrived at a EBT and EBIT also. So combined leverage formula equal to contribution divided by EBIT. We have contribution here. How much? 30 lakh contribution is there. Divided by EBT, which is 10 lakh. So 10 threes are, which is combined leverage equal to total 3. Right? Combined leverage is 3. That's it. Option 3 is the correct answer. How come 2.5, madam? How come 2.5? Interest is there. You should deduct the interest now, because EBT will be coming in the denominator. You are taking the financial leverage into account, but the question is about combined leverage. Combined leverage formula is contribution by EBT. Contribution by earning before tax, means after interest. After interest, before tax. Right? Question number 3. This is paper 1 now. Madam, I clearly mentioned it is commerce. And title also you can see. I was informing in group also. Now you are coming and asking, this is paper 1 now. Which of the following is not a true statement? Any transaction that increases a working capital is a source of fund. Depreciation is a source. major source of working capital in long run is profits from operation. Profit earned from non-operating activity is added to net profit while calculating profits from operation. So understand the question requirement. Which is false we need to identify, not true. Not true, which is false. Which is false. Two is the answer, Jiva Jyoti. Raj says 2. Soumya says 2. Babita 2. Danush Creation 4. Nadira 4. Are you sure? Which is false statement they are asking? So answer is option number 2 is a given answer. But I will tell you, we should disagree with this second statement. Means second statement also can be true. Possibly true. There is a possibility, high possibility to become true also. So in what context it is true, in what context it is false also you should understand. Let's make a proper explanation for this. Any transaction which increases the working capital is a source of fund. Because in the fund flow statement, increase in working capital is a source and decrease in working capital is an application. Obviously, first statement is true. Major source of working capital in the long run is profit from operation. Major source of working capital means whenever you are investing in a working capital, that means in the balance sheet current assets are more. That source is coming from the profit from operation, which is also correct because in the long run, profits are the source for any type of investment, whether you call it as short-term investment or long-term investment. Profit earned from non-operating activities added to net profit. Because in profit from operation calculation in the fund flow statement, non-operating activities will be added back to the profit. That's a general we do. Now here, depreciation is a source which is given as a false. Generally, depreciation neither a source, neither a source nor application. Generally, depreciation will not be treated as a source, will not be treated as application in general. But depreciation can be a source in one context. As asset value is coming down every year, a fixed amount or a fixed percentage, we are reducing the value of asset every year, which is for the wear and tear of the asset. That value which is accumulated as a depreciation, that depreciation we are reducing and taking away from the profit. Separately, we are keeping in depreciation account. So at the end of the useful life of the asset, the profit which we keep it aside as in the form of the depreciation is creating a source, to purchase the new asset now. In such case, depreciation will be a source. It may not be a source of the fund, but it will be a source to purchase the new asset. It will be a source to purchase the new asset. So in the context of the fund flow statement, depreciation neither a source nor application. That is perfectly false statement if it is a source. As they mentioned as source, it is perfectly false. But in the context of machine usage and useful life, that is correct. If depreciation can also be a source of fund. Depreciation can also be a source of fund. Source of purchasing the new asset. Right, next question. An option which gives the holder the privilege of selling the other party a fixed amount of some stock at a stated price on or before the predetermined date is known as call option. In an option, holder has the privilege of purchasing from other party a fixed amount of stock at a stated price on or before the predetermined date is called as an put option. So question is about call option and put option. Guys, do hit a like button if you like this session. when I'm giving explanation, if you want to go for more number of questions without any explanation, I can do that also. But when I'm giving explanation, please listen to the explanation. Number of questions are doesn't matter here. How much qualitatively we are solving the question by understanding each answer is important. Even if you are taking time, for someone it will be useful. Those who are thinking that explanation is not useful, you may exit from the class, obviously. Without any hesitation, you may leave the class. Because we feel it as explanation is on top. Explanation is our priority rather than quantity of questions. Call option, put option. Let me explain. Answer is 1. Both the statements are wrong statement because ulta they have given. This call option is statement 2. Put option is statement 1. Ulta they have mentioned simply. Here when the right to buy, we call that as a call option. When we are getting a right to buy, we call that as a call option. Right to sell is nothing but a put option. So here they have given ulta. The holder has a privilege of selling the other party a fixed amount of at a predetermined date. Isn't put. Right to sell is a put option. Right to buy, purchasing from the other party, right to buy is a call option. But they mention ulta. Opposite statement they have given. Call is for buy, put is for sell. Next. Forex spot is an agreement. FX means Forex. Spot is an agreement between two parties to buy one currency against the selling another currency at an agreed price for a settlement on the spot date. The date of maturity of a forward contract is more than 2 business days in future. Answer please. Answer is 4. Option number 4 is a correct answer. That both the statements are correct. So here simply they are asking about spot and forward contract. Spot contract and forward contract. Spot is nothing but immediately, like a vegetable market. You will give the money and take the vegetables. You will give the money to Kirana store and take the goods from the Kirana. That's a spot agreement. One currency against another currency at an agreed price on the spot date. On spot we are buying and selling. Whereas date of maturity forward contract is more than 2 business days in future. So forward contract is nothing but buying or selling a security at a specified date in the future. Whether it is 2 days or 2 months, that doesn't matter. When something is future date we are indicating, that is called as a forward contract. The future date we are indicating here. 6th question. Combined leverage can be used to measure the relationship between. Just now we have seen. Combined leverage can be used to measure the relationship between. 6th question. Quickly answer. So combined leverage is a relationship between answer 3, sales and EPS. In the given option, sales and EPS are contribution EBT. Also correct. I'll explain the 3 leverages and their relationship. See, look at operating leverage is related to operating risk. So sales and EBIT relationship depends upon the sales. 1% change in the sales. How much change is going to brought up in the EBIT? So it is operating risk related. Whereas financial leverage is nothing but EBIT and EPS related. The 1% change in the EBIT, how much percentage change is going to be there in the EPS? Whereas combined leverage is between the sales and EPS. Sales and EPS. So 1% change in the sales, how much percentage is going to bring a change in EPS? So this is operating or a business risk related leverage, and this is a financial risk related. This is combined business plus financial risk related leverage. Three types of leverage and their relationships. Next question. Which of the following statements is or false? Which of the following statement is or false statement? Negative. False they are asking. Capital profit can never be distributed as a dividend to the shareholder. Dividends are paid out of profits and therefore do not affect the liquidity position of the firm. Every company should follow the policy of low dividend payment. Walter Mollett suggests the dividend payment does not affect the market price of the share. Does not affect the market price of the share. So which statements are false? When these statements are given and the coding is given below, first look at the options below. Then you can eliminate certain things outrightly. Do hit a like button, guys, if you like the session, and subscribe to the channel if you have not subscribed. If you don't like a session, you can hit a dislike button and unsubscribe to the channel. Answer is option 2. Why it is 2? Why all are false statement? Why sub? Capital profit can never be, they are saying. Capital profits are the one which will be distributed as a dividend. Free capital profit. Free profits are eligible to declare or distribute as a dividend generally. So they are saying never and ever. Who said never and ever? Which is wrong or false. Dividends are paid out of the profit, so therefore do not affect the liquidity provision. When profit is going out, how it will not affect that liquidity? Profit is going out of your hand to the shareholder and they are receiving it. Obviously, it will affect the liquidity and working capital also. When profit goes much to the shareholder in the form of the dividend, less will be available for the investment as well as working capital also. Every company should follow the policy of low dividend. If there is only one policy that is low dividend, then market price of the company will be impacted in the different period of time. When they are in long run, when they are in short run, it will be impacting their market price if they go with a low dividend every time, even if the profits are available. So every time low dividend is not suggestible and not correct. Walter model suggests that payment does not affect the market price. Actually, Walter model and Gordon model both are relevant model. Relevant means whatever the dividend payment, whether you declare a dividend, does not declare a dividend. If you declare the dividend, it will be changing the value of the firm. If you don't declare a dividend, then value of the firm will be some other. So depends upon the dividend decision, value of the firm will be changing. That's why it is does not affect is also false statement. Does not affect is a false statement in such case. So total all the 4 statements are false due to these reasons. Next, which of the following is not known internal rate of return method of capital budgeting? Not known internal rate of return method of capital budgeting. Amount of cash outflows, life of the project, discount rate, amount of cash inflows. Means while calculating the IRR, which is unknown variable in this? First of all, by definition, IRR is what? What is IRR by definition? The rate at which present value of cash inflows is equal to present value of cash outflows. The rate at which present value of cash inflows equal to present value of cash outflows is an internal rate of return. Now in this, which is unknown? Hello, excuse me. The rate at which present value of cash inflows equal to present value of cash outflow. In this, which is unknown. So answer will be 3. The rate, internal rate of return. Rate is the one which you are trying to calculate, right? The rate is calculated. The rate we should calculate it. For that only we have a method called as an IRR method. So rate is unknown. Discount rate is unknown. The rate at which we are equating the present value of cash inflows and outflows, the rate we are trying to find out by using a trial and error method. The discount rate is unknown here. Discount rate is unknown here. So net present value, we are not given the discount rate. In the net present value, discount rate will be there. But in IRR, discount rate will be ascertained by trial and error method. That's why answer is option 3. Discount rate is the correct answer. Next. Very small question, but conceptual and you are making a mistakes also. See, none of the fellow has given correct answer except Nadira and Devansh. Under which of the following situations the decision outcome of an evaluation of investment opportunities vary under the NPV and IRR methods? It means due to what reasons the result between NPV and IRR is getting conflicted. Reasons behind conflict between the NPV and IRR outcome. Reasons behind NPV and IRR outcome. So in class also usually I explain each and every point that we are discussing. Those are paid learners. Between NPV and IRR. So 3 disparities will be there. One is time disparity, which means project life cycle. A project may be 5 years, B project may be 8 years. So due to this also the result may change in NPV and IRR. Cost, this may be 10 lakhs, this may be 15 lakh project cost. Life is nothing but here 5 years and 8 years life of the project. Time disparity means how many number of years the project is going to be there is one. And cash inflow is going to be there per year or else per month or else per 3 years or lump sum is going to be there. That's what a time disparity. So answer is A, B, C. Time and cost and life disparity. Even there is a cash inflow disparity also possible. That cash inflow disparity is nothing but time disparity. At what time the cash inflow is going to be there. So cost disparity is difference in amount of cash outlay. And cash flow patterns is the timing of cash flow every month or every year or every 3 years, every 2 years, like that. Life disparity, total entire life of the project. Different project will have a different unequal time period. Next, net income approach, Gordon model, IRR, reorder level. We should match with a list 2. Outrightly we are getting an answer. Net income approach is in capital structure theory. Net income, net operating income, traditional theory and Modigliani Miller. Gordon model is an dividend theory. Gordon, Walter, MM. Internal rate of return, NPV, all these are capital budgeting technique. Reorder level, maximum level, minimum level, EOQ, all are inventory management related. So here 3421 is the correct answer. Option B. Option B is the correct answer. Next, capital structure leverage decisions comes in the ambit of investment decision, distribution decision, financing decision, dividend decision. Let's see, this is a basic first page question from the financial management. Who will answer? Let's see. Everybody saying that C. Nani and Anita says Nani A, Anita B. Okay. And Apsar and Gopal says B. Okay, remaining all are C. Let's see. Capital structure and leverage are comes in the ambit of financing decision. It's an financing decision. So we have a three major types of decision. Investment decision can be of two types. Long-term investment, short-term investment. Long-term investment, capital budgeting. Short-term investment is working capital management. Right, working capital management. Whereas financing decision is of two types. Financing decision is of, you can say, capital structure decision, leverage decisions. Leverage decision, capital structure decision. And dividend policy is about dividend decision. And retained earnings, dividend will be there, retained earnings also will be there in this. Here in the financing decision, cost of capital also. Capital structure, cost of capital and leverage related. Okay, so answer is option C. Leverage and capital structure are comes under financing. Next question. Sale and lease back is more suitable for a lessee having liquidity crisis, surplus fund, high profit, no loss. First of all, you should know what is sale and lease back. All are saying A. Sale and lease back is generally arrangement useful for the lessee who are having liquidity crisis. Let me explain the sale and lease back. Answer is A, correct only. Here, one seller, I am the owner of this property, building, assume. I am the seller. I am in need of money. I sold my property to someone. So, A sold it to B. Now, previously, A was the owner, now B is the owner once we sold. And I got a cash. Immediately my liquidity crisis got fulfilled. Means whatever the cash I got and I immediately paid my requirements and I've done. Now after that, this seller, original previous seller will go to this recent buyer, whoever we sold the asset, and we will take a lease our asset. Whatever we sold the building, we will be taking on a lease basis from the same buyer. Then this buyer will be a owner now, and this person will be a tenant. The previous seller is a tenant now. So he leases the property. Buyer, once the certain period is reached, the seller will be able to also buy this same property from the buyer. So at some purpose, seller got the requirement of that liquidity crisis, and also he has taken back his asset again after certain period of time. So whenever lessee doesn't have such liquidity crisis, he no need to go for the sale and lease back. Whenever he is in need of money, at that time he will sell, later he will lease back the asset. That's why option A. Next, a statement of change in financial position typically would not disclose the effect of. Yes, correct. A statement of change in financial position typically would not disclose the effect of share capital issued to acquire the productive facilities, dividends on shares declared, cash dividend declared but not yet paid, purchase and retirement of a treasury stock. Treasury stock is nothing but the stock which is there on the warehouse, already stored one. So your answer is option B. B is the given answer. Answer is official key says option B is the answer. Look at here. If cash dividend declared but not paid, you declared and not paid. Here dividend on shares declared. Dividend on shares only declared. But you have not paid. You have not paid for those. Only shares, dividend on shares we declared. But you have not paid that. Here we declared the cash dividend. Once we declared the cash dividend, we can able to sense that cash will fall down in the future because that treatment is not yet made. Once we made the payment, then the cash will come down automatically. So that's why this will be showing an effect. So C cannot be answer. Here only dividend on shares declared will not be showing any effect on the financial position. Only this shares, this dividend is declared only. When we pay in the form of the shares, then it will be impacting on that. But as of now, it will not be impacting. So statement 2 can be correct answer. Next, according to NI approach, capital structure decision is relevant to the firm, valuation of the firm. A firm can change its total value by its overall cost of capital by changing the degree of leverage in its capital structure. Which one can be correct? NI approach. So answer is A. Both are correct. NI approach is by David Durand. According to this, it is relevant approach only, and traditional traditional approach also relevant approach. Only this NVO and NI approach are relevant, and traditional as well as Modigliani are irrelevant approaches. Next here, which of the following analysis is suitable for risk return analysis? Last and final question. 15 questions we targeted and 15 questions in 40 minutes. Risk return analysis. Which one? CAPM, capital asset pricing model. SWOT, SWOT analysis, that is strength, weakness, opportunities and threats. Capital gearing and economic value added, EVA. Which one will be related to risk return analysis? So answer is A. CAPM, capital asset pricing model. In this, how to calculate the cost of equity is important. Because out of all methods of cost of capital or cost of equity, only single method where risk will be taken into account is that CAPM model. Risk-free rate of return plus beta into market risk premium minus risk-free rate of return. This is totally a market premium. And here, market risk minus risk-free rate of return is a market premium by taking the risk coefficient beta plus risk-free rate of return. This is the one for cost of capital will be taking a risk into consideration. Right? So that's about today's session. I hope you like this series, and if you want me to continue, you can hit a like button and you can share with your friends. And for the PDF, you can join in our Telegram group or the groups which are available. As per your interest, you can join in our group, but join in any one group only. PDF will be shared there only. So stay tuned to the channel. You will be getting updated about the classes. Alternative day, I plan to take the commerce session, means day after tomorrow again next session will be there for it.